Hey, good morning, everyone. Marty Mazzora here. It is Friday, June 30th, 2023, with your weekly economic update. In front of you is the graph of our PWA index. I'll just tell you what we scored this week, and then I'm just going to jump right into the inputs that I've selected for this morning. So just a fractional move higher, 17 on the nose, or negative 17 on the nose, is our overall score. We've broken out of this downtrend to the upside. I've noticed a real improvement in sentiment overall about the economy. Definitely an improvement in sentiment as we score markets. However, we're still notably below the zero line, which suggests that odds yet favor recession in the relatively near future, as opposed to continued expansion. As for the inputs I wanted to share with you today, retail sales, the main statistic folks watch, is out for the month of May. We also track Redbook's weekly survey, and it continues to drop, up just 0.5% this last week. And it looks very recessionary from a trend standpoint, as I continue to point out. Personal consumption on a rate of change basis actually came down a little bit in the month of May, interestingly. Personal income, however, ticked up just a little bit on a month-on-month basis. Annually, down slightly, but still a robust 5.5% increase. Personal savings rate actually ticked up a little bit to 4.6%. And again, balance, of course, that sounds like a good thing. However, personal savings rates tend to increase as folks get concerned about their economic prospects. As you can see here, these lines I'm drawing are pops in the savings rate heading into the past few recessions. Mortgage purchase applications popped pretty nicely here this last week, and as you can see, we have a higher low. And very interesting, the dynamics around the housing market. We've talked a bit about that here. Existing home sales, there's little, if any, inventory. So when something comes on the market, it's a hot item, multiple offers, that sort of thing. The fact that there's such little inventory opens the door for builders in the new home space, and they seem to be fairly aggressively buying down mortgage rates, cutting prices. I think it was a 7% decline year over year in new home prices. So we've got this interesting, higher interest rate / COVID related dynamic to housing. We need to be thoughtful about as we gauge these numbers. And like a lot of these other things, again, I think there's legitimate optimism in that short-term trend right there. However, it's not unusual, folks, again, to see pops in a lot of these, economically sensitive indicators as we enter recessions. You can call them blow off tops, what have you. And of course, we're still sitting at historically low levels in mortgage originations. So we'll keep all that in mind as we move forward. Consumer confidence, both of the measures we look at, the conference boards earlier this week and this morning, the University of Michigan's, again, historically low level, but very much moving in the right direction. So consumers on balance are feeling better about their circumstances going forward. Again, you can see that that's not unusual even as we get close to recession. The Kansas City Fed Labor Market Conditions Index, I believe, is 24 different labor-related data points, and it's rolling over in a fashion that it never has before without being followed by a recession. It hasn't been around that long, 31 years, so not a big sample size in terms of recession, but again, it speaks to labor market conditions overall, a deeper dive than just the jobs number and so forth. Obviously, it's more of a forward-looking indicator, and it is flashing a big red signal as it relates to the state of the economy going forward. U.S. Economic Surprise Index, on the other hand, has popped up to, call it 42. And again, remember, you can see how noisy this is, that this is not about necessarily the state of the economy overall. It's just the state of the latest data compared to what economists had forecast previously. So when we're below zero, that means the data is coming in worse than expected. When we're above zero, it's coming in better than expected. And I think that also speaks to what Fed Chairman Powell has been speaking to in terms of trying to get the market used to the idea that there could very well be rate increases in the July and the September meetings. I get it. The data is suggesting that they need to be concerned about entrenched inflation above their 2% target. I think they're concerned with how the market is not believing them. Frankly, we don't either, because we see weakness in the second half of the year. And if it's weaker than what a lot of people are discounting, well then, no, you won't see 2 more rate hikes by the Fed. I'll be surprised if we don't get one in July. But as I keep telling you, like the PCE data this morning, CPI is going to come in soft for July. But I think they're looking through that. And I already said that in this morning's stock market commentary, that the base effects do not favor the Fed in terms of their inflation fight the second half of the year. They're going to need the economy to roll over some. And I think they are doing their darndest right now to try to talk the economy down a bit. And frankly, the market's down a little bit. It's just that the markets aren't listening right now. The inflation component, the deflator in the PCE numbers, already mentioned that this morning. You can see a pretty good drop-off in headline inflation. That was consistent with expectations. Core came in at 4.6, which was a little lower than expectations were. And then the monthly change in the headline, you can see 0.12%. And again, that's very consistent with the story we've been telling the last few months. Copper really rolled over. Remember last week we were looking at a price that was moving back above the 50-day moving average. Since last week, more concerning macro data out of China. I think copper is relatively tethered to the outlook for the Chinese economy. Again, though, it does not mean we need to entirely discount its historic reputation as an overall indicator on the global economy at large. And right now, the copper price is rolling back over, and that would be a negative sign. Now, remember, folks, and I'll remind you of this often, we are raging bulls for so many good, fundamental, long-term reasons on a long-term basis in copper. We did early March cut some of our related exposure because of our recession call. And if we do have recession, I think copper goes lower. Ultimately, I think copper goes substantially higher, but I'm talking about a multi-year thesis. Right now, we're dealing with the next few weeks and months. Some of the market data that we look at, sectors relative to the S&P 500, this improved in our scoring this week. XLK is tech. Anything over 100 means it's outperforming the S&P. Financials are underperforming, at least on a one-month basis. Yesterday was a big day for financials. Consumer discretionary significantly outperforming the S&P. Materials outperforming the S&P on a one-month basis. Energy underperforming. Industrials outperforming. But then we get to defensive sectors. Staples underperforming the S&P. Utilities underperforming the S&P. Healthcare underperforming the S&P. And what we're seeing here, folks, is an improvement in breadth, where it's not just all about technology over the past month. And this has got the bulls excited, is that, we've had this incredible divergence where we've had just a handful of stocks that really explain all of the gains so far this year. That's the case, but the equal weight index, for example, is beginning to improve a bit, which bolsters the bull case, that rather than these handful of stocks coming plunging down, that the rest of the market rises up over the second half of the year. I am concerned that narrative will not play out the way folks think it will. Our data and our work says there is still significant risk in this market. And ironically, the more bullish everybody gets amid the overall macro backdrop that we're seeing, the more likely something very negative in the second half of the year comes to pass. So we'll keep you up to date on that. We are objective, I assure you. And frankly, we're quite happy with the results the first half of the year. Like I said, we need to be in a position where we're defensive enough to mitigate the effects of something really ugly to the downside, and we think that risk is elevated. But there are enough opportunities in this market, and many of them are not even related to stocks. You know, we have a not small commodities exposure. But again, as I've suggested, that can be in jeopardy as well in a weaker economic environment. Hence, we did some cutting of that exposure, as I already mentioned. So this is a market where you need to be very tactical, I think. You need to be nimble and on your toes. And again, have some hedging in the portfolio to mitigate the effects of something ugly if something breaks. Keep in mind that amid all of this, improving economic data, I've been listening to Bloomberg this morning, in the background as I've been doing all of our research. And it's just kind of bull after bull after bull has been coming on. And that's not something we were hearing, just a few weeks or months ago. And we were hearing more pessimism. And as I pointed out, the more the pessimism you have, the more ultimate support you may have for the market. The more everybody moves to the bull side of the boat, the more dangerous it gets in terms of the effect of something breaking or some disappointing data. This morning, all we're hearing about is that Apple is now the first company ever to hit the 3 trillion mark. Now, previously, the last few years, when it hit the 1 trillion mark and the 2 trillion mark, it proceeded to see declines of, I believe, 40% and 20-something% respectively. That in and of itself doesn't mean that Apple and the market is going to roll over. Apple is very overbought. So the setup is very much like it was when it hit these other, trillion market cap marks. I could speak at length about how good a shepherd Tim Cook has been of the stock price with all the buybacks and so forth. But that's okay. Wall Street loves that, and he continues to deliver. And then lastly, the yield curve. This one you will hear over and over again is the best indicator of recession, and it is as inverted as it's probably ever been historically. I think you got to go back to the early 80s. So this is an utterly ominous sign about the prospects for the economy going forward. But notice the recession tends to occur when the yield curve re-steepens. For example, up here is a 2-year yield is notably higher than the 10-year yield. 2-year is probably the most respected indicator of where Fed funds are going. Okay, and this would suggest higher. The 10-year is indicative of where the market sees the economy going, right? People will buy bonds, and that will push yields down when they think that the future is going to be one where the Fed is cutting interest rates, for example, because we're in a slowing economic environment. The re-steepening would come when it's anticipated that the Fed is now going to have to react, cut interest rates, the short end comes down in yield faster than the long end does, and all of a sudden, boom, you're in recession. So we will see, but make no mistake, history says that recession is coming. I think the one false signal was in 1964. So stay tuned, folks. Very interesting dynamics. We've got another big options expiration come July 19th. The experts who we respect in that space suggest that if not before then, thereafter kind of opens a window for some potential downside in the market as it relates to options dealer positioning and that hedging and so forth. We have recently, because volatility was so cheap, we moved our S&P 500 hedge all the way out to July 31st, so we bought some time on that we can sit and kind of let things evolve. We may roll it in the meantime if we think there's an opportunity to do that. So stay tuned, folks. It's going to be very, very interesting in the coming weeks. Hope you have a good weekend, and I'll talk to you again very soon. Take care. Bye-bye.